In just a single leg down, Bitcoin wiped out over $1 billion in long positions, sending shockwaves across the entire crypto market. Has Bitcoin finally bottomed? Or is it about to fall even further? Should I cut my losses and walk away? While retail investors are desperately trying to catch the bottom, hoping for the next explosive rally, whales, market makers, and especially spot Bitcoin ETFs have quietly accumulated nearly 60,000 BTC in just the past 30 days. The financial game has changed dramatically in 2026. The days of buying any random coin and making easy money are over. Today's market is far more competitive, selective, and unforgiving. The real question isn't, how low can Bitcoin go? The smarter question is, which price zones offer the highest probability buying opportunities, and which ones are simply technical bounce traps designed to lure late buyers before another leg down? In today's video, we're going to answer one of the biggest questions every investor is asking right now. Where is the smartest place to buy Bitcoin during this market cycle? Instead of making emotional predictions, we're going to decode Bitcoin's future using 3 critical price zones, identified through the convergence of technical analysis, on-chain metrics, and global macro liquidity. Be sure to watch until the end, because we'll also cover a capital allocation strategy designed for this market environment. Before identifying where Bitcoin may bottom, we first need to understand where we are in the current cycle. After reaching an all-time high of approximately $126,000, Bitcoin has entered a significant correction, losing nearly half its value and briefly revisiting the $60,000 area. Behavioral finance experts describe this stage as the post-euphoria phase. What does that actually mean? Liquidity hasn't disappeared from the market. The money is still there. What's changed is investor confidence. After such a painful correction, retail investors are no longer willing to buy every dip with blind optimism. Fear has replaced FOMO. Today's Bitcoin market is being pulled in 2 completely opposite directions. On one side, institutional demand remains remarkably strong as major spot Bitcoin ETFs continue accumulating for long-term holdings. On the other side, global macroeconomic uncertainty, including high interest rates, slowing economic growth, and ongoing geopolitical tensions, continues to weigh heavily on risk assets. This tug of war has fundamentally changed Bitcoin's behavior. Rather than following the traditional 4-year cycle, Bitcoin is increasingly moving in sync with global liquidity cycles. Let's break down the 3 price zones every Bitcoin investor should be watching. Zone 1. $57,000 to $60,000. This is arguably the most important support zone on the chart. From a technical perspective, this range aligns closely with the 200-week moving average. For more than a decade, the 200-week moving average has marked the dividing line between long-term strength and deep capitulation. This zone also carries enormous psychological significance. It represents the previous cycle's breakout area from 2021 and served as the major accumulation base throughout early 2024 before Bitcoin surged toward $126. If buyers successfully defend this area, Bitcoin's long-term bullish structure remains completely intact. This would represent the healthiest and least disruptive scenario, allowing the market to consolidate before resuming its primary uptrend. However, experienced investors never prepare for only one outcome. If worsening macroeconomic conditions or geopolitical risks cause Bitcoin to lose the $57 support level, the market could quickly move toward the next critical area. Zone 2. $51,000 to $53,000. Historical price action shows that this is a low liquidity zone. Whenever Bitcoin trades through this area, price tends to move extremely fast in both directions, often producing swings exceeding 20% as large clusters of stop-loss orders are triggered. For short and medium-term traders, this isn't necessarily the ideal place for long-term investing. Instead, it offers one of the best opportunities to capture powerful technical rebound rallies. Zone 3. $41,000 to $44,000. This is the most compelling long-term accumulation zone on the chart, and it's far from arbitrary. This price range represents the convergence of multiple high-conviction technical indicators and on-chain valuation models. From a technical standpoint, reaching this area would complete a textbook 5-wave Elliott wave correction, signaling that the broader corrective phase may finally be coming to an end. From a liquidity perspective, this is also where a significant concentration of leveraged positions would likely be liquidated. A final flush into this zone would force the remaining weak hands to capitulate before a new cycle begins. On-chain metrics reinforce this thesis. Several major valuation indicators historically associated with market bottoms begin flashing oversold signals in this region. The Sharpe ratio approaches historically low risk levels. The MVRV ratio suggests Bitcoin is trading below its network's fair value. Meanwhile, the Bitcoin 200 WMA heat map shifts into its long-term accumulation zone. For the average investor, this would likely be the most emotionally painful phase of the cycle. But historically, periods of maximum fear have also provided the foundation for Bitcoin's most explosive bull markets. At the end of the day, success in financial markets doesn't come from perfectly predicting tops and bottoms. It comes from managing risk and preparing for multiple scenarios. Remember, financial markets transfer wealth from the impatient to the patient. If you found this breakdown helpful, don't forget to like, subscribe, and turn on notifications so you never miss our next in-depth market analysis. Thanks for watching.